A very good morning to you all. Thank you for joining us today in large numbers to discuss an important topic that affects all business in the UAE, which is corporate tax, which has already become effective from 1st June 2023. Although the BEAR Act was released in December 2022, subsequent to that, a lot of cabinet and ministerial decisions have come out, and also a lot of clarification issued by FTA, and this has to be properly understood in the right context. There's a lot of clarification issued which includes matter related to permanent establishment, place of effective management, transfer pricing, threshold limits for mandatory audit of financial statements, and also threshold limits for mandatory maintenance of detailed transfer pricing documentation. But the most important cabinet decision was regarding the taxability of free zone companies, particularly on the qualifying income and qualifying activities and immobile property. A qualifying free zone has to meet certain conditions to opt for the zero tax rate. One pertinent point I want to make out is regarding the companies in the free zone, which basically carry out high sea sales, which are not covered in the list of qualifying activities. And I believe these companies will be subject to 9% corporate tax. And I believe many companies in the free zone operate on this model. However, in the coming days, we expect more clarification on this matter. Also, qualifying free zone companies whose non-qualifying revenue exceeds the lower of AED 5 million or 5% total revenue will be subject to 9% corporate tax. The classic example is the free zone company, which carries out business in the mainland. I feel most of the free zone companies carry out business in the mainland, and hence they have to be mindful of this fact that the business in the mainland does not exceed lower of AED 5 million or 5% of total revenue. My tax colleagues, Shailesh Kumar and Radhika, are going to take you to the presentation details, and we're planning to cover the following aspects. Overview of corporate tax, along with the snapshot of the ministerial decision released, qualifying free zones and qualifying activities, participation exemptions, place of effective management versus permanent establishment, transfer pricing documentation, and tax grouping. I encourage all of you to participate by raising questions in the chat box, and we'll try to answer them at the end of the session. My message to you all is, although the corporate tax regime has begun, one needs to carefully evaluate the law and assess its impact on the businesses and ensure compliance is done in time. Thank you once again for participating, and I hope you find this presentation informative and also thought-provoking. So without any further ado, I hand over the proceeding now to Shailesh Kumar. Shailesh, over
Thank
to
you,
you.
sir. Thank you, sir, for your wonderful words and which enlightened us in terms of the perspective of this law, as well as the presentation that we are doing is essentially for the information of the participants. And there are the decisions, the law as well as the decisions issued by the government. They give some clarifications. At the same time, there are certain questions which are still unanswered, on which a careful consideration needs to be taken by the taxpayers. On some of the aspects, the government may come up with further clarifications also. So we will need to watch all these developments very carefully, and take the careful considered decision. So there is no need to panic that the law has already, the corporate tax regime has already started. But at the same time, they are careful and considered, conscious evaluation of its impact for the business needs to be evaluated, and all the business decisions need to be taken in light of that. The businesses where there are some restructuring required can be done in light of the commercial requirement, and not solely with the objective of reducing the tax liability, which may come within the purview of general anti-abuse rules. So in light of that, we'll just start off with the presentation. Myself and my colleague Radhika will take you through the presentation, and then in the end, we'll take the questions. So as we see, the overview of corporate tax regime, it consists of the four major pillars as of now. So first is the decree law, which was issued in December 2022. Then after that, there have been total 26 decisions which have been issued by the government in different forms. 5 cabinet decisions, 18 ministerial decisions, and 3 FTA decisions are there. There is a detailed explanatory guide issued by the FTA in terms of explaining the different articles, the perspective behind different articles, which throw a lot of light on what the government is thinking and what should be the interpretation of the corporate tax law. And the registration, corporate tax registration process has also started for the public joint stock companies as well as for the private companies through the Imara tax portal. However, there is no timeline as such to register for the corporate tax except certain entities who want to claim exemption, which are listed in FTA decision number 7 of 2023. Except those cases, there is no timeline to register for the corporate tax. So our advice is to start the registration process only after you have finalized on your structure, your shareholding, etc., in terms of the grouping requirements and other things. So we'll just take you through. So our first topic, uh, in the next two slides, we've given the snapshots of various decisions which are issued by the government. So you can go through this snapshot. So there is a fairly detailed list of decisions, already 26 decisions issued, and many more to come on various topics, which we will cover in the presentation in the later slides. The first topic that we are going to start with today is on the qualifying free zone income. As Mr. Pereira has already mentioned, that this was the most awaited and most important decision, which has been issued on the 1st of June itself, on the first day of this corporate tax regime. So, and this was the most awaited because free zones form a very important part in the economy of the UAE. A large number of companies operate out of the free zones. A lot of offshore companies also, which are set up in the free zone. So all those companies have been waiting for these decisions on a very eagerly basis. So we what kind of benefits are there? We'll see in the next slide what kind of benefits are there. So essentially, the government has issued two decisions covering the qualifying activities and qualifying income, excluded activities, and other conditions for these free zone persons. So these decisions are Cabinet Decision number 55 of 2023 and Ministerial Decision number 139 of 2023. While the Cabinet Decision prescribes the scope of qualifying income and other conditions, the Ministerial Decision in detail prescribes the list of qualifying activities, excluded activities, and all, and also the de minimis requirements. So what all are these conditions? First of all, we need to understand that who is a qualifying free zone person. A qualifying free zone person is a entity either incorporated in or branch of a foreign company which is registered in a free zone. There is still a question mark whether branch of a mainland company will be covered in that definition of a free zone person or not, because in the decree law, branch of a mainland company is not specifically mentioned, whereas in the explanatory guide, even branch of a mainland company is covered. So there is some gray area around that. But essentially, qualifying free zone person is a free zone person, free zone entity, which meets certain conditions. What are these conditions? First and most important condition is that the qualifying free zone person must maintain adequate substance in the free zone. And by meaning the substance test, it means that it should undertake its core income generating activity in the free zone. It should have adequate assets. It should have adequate number of qualified employees. It should incur an adequate amount of operating expenditure. in that free zone entity. And even if some portion of the work or whole of the work is outsourced, it can be outsourced only to another entity in a free zone, subject to control and supervision is maintained by the qualifying free zone entity. So these are most important conditions, saying that, a lot of people they ask this question that whether, just by setting up a company, or in fact many of the companies in the free zones, they operate out of, workstations like, hot desk kind of workstations, and also whether they will also qualify. So these conditions are very important to see. And if there is just a paper office in the free zone without an actual office, or without having the sufficient number of employees, or without having the sufficient number of assets which is required for carrying out the core income generating activity, then the substance test may not be met, and the qualifying free zone benefit may not be available. So meeting the substance test and passing all these conditions are very, very important. So this is the first condition. Second is, it derives the qualifying income as defined in the cabinet decision number 55. So what is the qualifying income? Qualifying income for a qualifying free zone person, any income derived from another free zone person is a qualifying income, except it is an excluded activity. So in the next slides, we will talk in detail about the what all are the qualifying activities and excluded activities. So we'll talk about that. So, but as a matter of principle, for a qualifying free zone person, any income derived from another free zone person is a qualifying income, except it is an excluded activity. Secondly, income from any non-free zone person, whether it is a mainland customer or from an outside UAE customer. So both will be, so there is no classification, or there is no bifurcation between a mainland and an outside customer. The only classification is between a free zone person and a non-free zone person. So any income derived from a non-free zone person will also be a qualifying income if it is derived only from the qualifying activities, right? And third is non-natural person. So generally, any income derived from a natural person is an excluded activity, except for prescribed activities, essentially in the nature of fund management, wealth management, and all. So that again we have covered in the next slide. So if these three conditions, these three type of income are received by a qualifying free zone person, then it will fall within the scope of a qualifying income, and this second condition will be satisfied. Third is that he has not elected to be subject to 9% corporate tax. So this election is very important, and when the first year of return will come for the first tax period, whether it starts for a taxpayer from 1st of July, or it starts from a taxpayer from 1st of October or 1st of January, which is the most, which is in the maximum number of cases, uh, an election will have to made by the qualifying free zone person, saying that it is willing to apply for a 0% corporate tax, because in many cases it really depends on the cost benefit analysis, and it is a conscious decision which has to be taken by a qualifying free zone person in case whether it meets the necessary conditions or not, and whether it wants to elect for a 0% corporate tax, or it wants to pay or fall under the normal 9% corporate tax regime. Fourth condition is it complies with the transfer pricing. Fifth condition is it meets any other conditions as prescribed in the cabinet decision number 55 and ministerial decision number 139, which essentially are prescribed, and which includes the de minimis requirements and exclusions of the qualifying income. So de minimis requirement, as Mr. Pereira has mentioned, that any income from which is not in the nature of qualifying income should not exceed 5% of the revenue, or 5 million dirhams, whichever is lower. In case the income from non-qualifying activities or excluded activities exceed this any of these threshold, then the entire income of the qualifying free zone person may be subject to 9% tax, and they lose this 0% tax benefit not only for 1 year, but for the next 4 years also. So total 5 years, they will lose this benefit of 0% tax benefit. So meeting this de minimis requirement, so while claiming this 0% tax benefit, it is very, very important to ensure that you meet the de minimis conditions, and then only you claim this 0% tax benefit. Some of the items are excluded from the definition of qualifying income in the ministerial decision number 55. And one is income attributable to any domestic PE or a foreign PE of the qualifying free zone person. Domestic PE is essentially any PE within the mainland outside of the free zone. And foreign PE is, of course, any permanent establishment in a foreign country, and any income attributable to any immovable property located in a free zone and which is derived from a non-free zone person in respect of a commercial property, that is also an excluded income for calculating the de minimis requirement. It may be also important to note that the government may come up, so till now the government has not issued, but the government may come up with a list of free zones also for which are to be notified for considering an entity to be a free zone person. So that scope is already there in the UAE corporate tax law definition. So we can expect a notification or decision from the government on that also. So now we talk about what are the qualifying activities. The qualifying activities include manufacturing of goods or materials, processing of goods or materials, holding of shares and securities, essentially for the free zone companies, which are essentially the holding companies, ownership, management, and operation of ships, reinsurance services regulated by the concerned UAE authorities, fund management services again by the regulated by the concerned authorities, wealth and investment management services regulated by the concerned authorities, headquarter services only to the related parties, treasury and financing services, essentially the loan, etc., given to related parties, financing and leasing of aircraft, including engines and rotatable components. Uh, then comes the one of the most important and talked about is the distribution of goods or materials in or from a designated zones. So here it is important that distribution of goods or material from any free zone will not be eligible within the list of qualifying activities. This distribution has to happen in or from a designated zone only, and a designated zone as referred in the VAT regulations. There are total 27 designated zones as of now. So in the ministerial decision, they refer to the same VAT regulations for designated zones, and this distribution or trading from the designated zone has to happen to a customer which is a reseller. So it has to be a B2B transaction, and the activity of distribution must be taken in or from the designated zone, and goods and materials should entering the UAE should be imported through the designated zone. So that is where Mr. Pereira also mentioned that third port shipments or drop shipments which are not imported through the designated zone and which pass on without touching the UAE shores, it may not qualify within the scope of this distribution of goods or materials, this qualifying activities, which is mentioned in the ministerial decision number 139. Last is the logistics services, and any activities which is ancillary to activities which are above mentioned. So we have to see what is the main activity, and if there is any ancillary activity which is also provided, then that ancillary activity may qualify. So here the most important thing for the taxpayers, for the companies, will be to ensure that their activity, if they want to claim this benefit of qualifying income, and when they are dealing with a non-free zone person, if they're dealing with a free zone person, then they have to see the list of excluded activities when they are dealing with a non-free zone person, whether with a mainland customer or with a outside UAE customer. they have to ensure that they fall within this prescribed list of qualifying activities, and also their trade license should be appropriately reflecting these activities. So it should not be that, while you claim to do some of the activities, but when your trade license doesn't capture any of these activities, then possibly it may be a question mark on your eligibility to claim. So review of your trade licenses and all is very important to that it reflects it correctly. Then comes the list of the excluded activities which you cannot do. So, which you cannot do even with a free zone person for if you want to claim this 0% tax benefit. So, one is the transaction with any natural person you cannot do except these four activities, which are ownership, management, and operation of ships, fund management services, wealth and investment management services, and financing and leasing of aircraft. So these four activities, these four services you can provide even to a natural person, and it will fall within the definition of qualifying activities. Other than that, anything, any transaction you do is be it a trading activity or be it manufacturing and sale. In that event, it will fall within the list of excluded activity and specifically denied the benefit of this 0% corporate tax. Any banking activity is excluded. Insurance activity is again excluded. Finance and leasing, except what is already mentioned as treasury and financing services to related parties, is also excluded. Ownership or exploitation of immovable property other than commercial property located in a free zone, and the income is received from the free zone person, that is also in the list of excluded activity. So there are a lot of questions in terms of hotels and all which are located either in the free zone, whether that will be be subject to the 0% corporate tax or not. So they have been specifically excluded, mentioned in the list of excluded activity. Ownership and exploitation of intellectual property assets. So this is again one of the common questions which is coming. There are a lot of technology companies which license their technology products and all, and their income may qualify within the nature of ownership and exploitation of intellectual property assets. Even that is kept in the list of excluded activities, and you cannot claim a 0% corporate tax in that. And again, any activities ancillary, which is ancillary to these excluded activities, that will also fall within the definition of excluded activities. So the key points for discussion with some of the other aspects for getting the qualifying free zone benefit 0% corporate tax is again one thing is we have already discussed on the distribution, that as of now it appears that the only the goods which are imported from outside of the UAE and imported into the designated zone, that may result into a 0% corporate tax. Any drop shipment may be subject to a 9% corporate tax unless any further clarification or guidance is issued by the government on that. Services. All services provided by a qualifying free zone person to another free zone person shall be taxable at 0%. Any services which are other provided to a non-free zone person shall be taxable at 9%, except the following limited activities, which is ownership, management, and operation of ships, which is a qualifying activity, reinsurance services, fund management services, wealth and investment management services, headquarters services, and treasury and financing services to the related parties, financing and leasing of aircraft, and logistics. So only these limited 6-7 type of services are eligible for a 0% corporate tax, as any other service provided from a free zone to a non-free zone person, whether it is in the nature of service provided to a mainland customer or to a overseas customer, will be subject to a 9% tax. This is against the normal popular belief that that any export of service will also qualify for 0%. So this is not in line with that expectation actually. One important condition which is mentioned in the Cabinet Decision 55 is that if you're dealing with a free zone person, because all your income from a free zone person will be subject to a 0% corporate tax except the excluded activities. In order to avoid any situation of a tax abuse or creating a conduit for getting this tax benefit, it has been mentioned that the free zone person to whom such services are provided or from whom the revenue is received should be the beneficial recipient of such or goods or services, means he should have the right to use and enjoy the goods or service, and he should not have any contractual or legal obligation to pass it on to any other customer. So the person who's receiving the services or goods from the qualifying free zone person, they should be the beneficial recipient, and they should have the right to take a decision what to do with such goods or services without determined by any prior contract or a prior legal obligation that they have to pass it on to somebody else who may not be eligible for for this free zone benefit. So this is a very important aspect of not interposing entity just for the sake of free zone benefit. So this is an important aspect which needs to be considered. Free zone branch of a mainland entity, as we mentioned, there is a gray area on that because the law specifically does not mention that. However, in the explanatory guide, it is mentioned that branch of a mainland company may also in the free zone may also be falling within the definition of a free zone person. So we may expect some clarification from the government on that, or a private clarification may be requested from the government. The window for private clarification, as we checked some time back, it's not yet open. So that also we are waiting. And if any of the conditions, as I mentioned, is not fulfilled, then the free zone benefit is lost for that year. 0% tax benefit is lost for that year and for the 4 subsequent years as well. Next, we talk about a participation exemption. So participation exemption is essentially an exemption given to an investor who holds a minimum percentage of 5% of ownership interest in the investee company. So and which is essentially either in a foreign jurisdiction or even within the UAE. So the government has issued ministerial decision in terms of what all will be the conditions which needs to be satisfied for getting this benefit of this investment in a qualifying in a investment in a participating interest. So the first and main condition, which is that in case, so what is the benefit of having a participation exemption? First of all, we need to understand. So any dividend or other profit distribution received from a participating interest is not taxable. So any dividend or profit distribution received from a domestic company is not taxable any case because that is already subject to a UAE corporate tax. But even from a foreign company, foreign non-resident person, any dividend or profit distribution is received and the conditions for participation in participating interest are met, then that dividend and other profit distribution is not taxable. Then gains or losses, essentially the capital gain on transfer or disposal of that shares in the part or that participating exempt is also in the nature of exempt income. So here it has to be seen that this capital gain exemption is available from a foreign participating interest even as well as the domestic participating interest also. So there also these conditions for participating interest are very important. Any foreign exchange gains or losses in relation to a participation exemption that is also exempt. Impairment gains or losses in relation to a participation exemption that is also exempt. So for claiming this exemption in respect of these kind of income, it is most important to see whether you qualify, your investment qualifies as a participating interest or not. So first condition which needs to be seen is that you should have minimum 5%, means 5% or more ownership interest in the share capital of the participation. And if by any chance you don't meet this 5% condition, and your investment is less than 5%, essentially, to encourage investment in shares of the blue chip companies which are there overseas, where you make the sizable amount of investment, still the size of the company is so big that you cannot get the 5% ownership interest. So in that case, they mentioned that if your total acquisition cost or investment in the is minimum 4 million dirhams or more than that, then also you will qualify as it will qualify as a participating interest for you, and you can get the benefits as we mentioned about the exemption of dividend, capital gain, and other profits arising from the participating interest. There should be a minimum holding period of 12 months in the participating exempt, and the participation, the investee company in which you are holding the shares should be subject to a corporate tax or similar tax in its home jurisdiction at a rate not less than 9%. So this is the most important condition. So if you are holding shares in a company, suppose in Bahrain, where presently there is no corporate tax, then this condition may not be satisfied. Whereas if you are holding this investment in, say, KSA, where the rate of corporate tax is more than 9%, then the participation exemption may be available. These are the simplistic examples that I have tried to put in. Uh, then other conditions which are applicable, which need to be considered, is that exemption will apply to the taxable person only if he has the control and right to the economic benefit produced by the ownership interest. So this is essentially the beneficial ownership condition which is there. And expense incurred for acquisition, sale, transfer, disposal of participation in interest will not be deductible while calculating your other corporate tax, your taxable income for the corporate tax, because those are anyway incurred for earning an exempt income. So this is the general principle that if you're earning an expenditure, if you're incurring an expenditure for earning an exempt income, you cannot claim benefit of that expenditure against your other taxable income. Then the certain other terms have been defined and other conditions have been given. So one is the ownership interest. So ordinary, preferred, redeemable shares or partnership interest, it will all be considered within the definition of ownership interest. Other kind of securities or capital contribution that entitle the owner, shareholder, to receive profit and liquidation proceed, that is also included. And this ownership interest should be classified as an equity interest under the accounting principle, accounting standard. So and it is not necessary that you should hold only one kind of share. So suppose if you are holding a equity share and a preference share in the same company, then both these will be clubbed together to qualify to calculate whether you meet this 5% criteria or not, or whether you meet this 4 million dirham criteria or not. Even if you are holding some shares and your other group company is also holding some shares, even those two ownership interests can also be clubbed together if one has a direct or indirect ownership interest of at least 75%. So there should be minimum 75% common shareholding in the investor entity, or the investor should be held 75% minimum, to fall as a qualifying group. So in that case, both the entities together will be considered whether the participation exemption threshold is met or not. And for the for subject to tax, it has to be the effective tax rate, ETR, has to be considered to be seen whether it's more than 9% or not. So these are some key aspects which I wanted to discuss about, and then I'm requesting my colleague Radhika. So she will talk about certain other important aspects, and then we'll take the questions. Thank you.
Thank you, Shailesh. Thank you for the insightful discussion. Yeah. The first topic I'm covering is POEM versus PE. Basically, here the law covers the concept of POEM, that is place of effective management, as well as there is a concept of place of management in the definition of the fixed place PE. So here the definitions have been categorically provided in the explanatory guide. So whether foreign entity can be considered as a place of effective management in UAE, the key factor to decide that would be where the key management and commercial decision concerned with the broader and strategic policy matters necessary for the conduct of the company business are regularly and predominantly taken. So that would be considered as a place of effective management in UAE. And this will ordinarily be a company's board of directors or any equivalent body for other types of juridical person makes these decisions. And here one important point was mentioned in the explanatory guide that the residency status of the directors will not be important. And whereas while determining the PE exposure, it is mentioned that where the decisions necessary for the day-to-day conduct of the foreign entity's business are in substance made, and where the implementation of also takes of the day-to-day management, that would be considered as a PE. So where there's a POEM exposure, that foreign company will be considered as a UAE tax resident and its worldwide income shall be taxable in UAE. And in case of a PE, it shall be the foreign company shall be construed as having a PE and the income attributable to such PE only shall be considered as taxable in UAE. A very important point here would be when we go back to the CT law, the law as per the clause 3B of the Article 11, it says that it covers resident person's definition. So basically, it includes a resident person includes a juridical person that is incorporated or established otherwise under the legislation of foreign jurisdiction that is effectively managed. That is POEM. And as per clause 4, it says that a non-resident person is a person who is not a resident person under clause 3. So we will go to this clause only if we don't get covered under 3B. So the moment we are saying that we are POEM, then Article 4, which refers to the PE exposure, will not get covered into that. So that's why it is mentioned. Thus, where the foreign entity is considered as effectively managed and controlled in the UAE, that is forming a PE, then analysis under PE provisions for that specific entity will not be required. The next is Nexus. So on the similar lines of PE, recently a decision has been released with regard to Nexus. So a non-resident person who has other than P and state source, it talks about nexus. So in case where the non-resident person has a nexus in UAE, then it will be subject to tax in UAE. So what is nexus? It is defined as a non-resident person shall have nexus in UAE if it earns income from any immovable property in the UAE. And immovable property is defined as any area of land over which rights or interests or services can be created, any building, structure, or engineering work attached to the land permanently or to the seabed, and any fixture or equipment which makes up a permanent part of the land or is permanently attached again to the building, structure, engineering work, or to the seabed. And the income which can be considered as attributable to the immovable property will include the income derived from the right in rem, sale, disposal, assignment, direct use, letting, including subletting, and any other form of exploitation of such immovable property. Here, an important point to be noted is that specifically it is mentioned that GAR will be triggered in case if the non-resident artificially transfers or disposes of its right and rem in any movable property in the state to another person, and that transfer or disposable is not for a valid commercial or other non-fiscal reasons. So this should be taken care of. Be mindful about that. So, and the next compliance requirements is case a person having a non-resident person having nexus in the state shall be required to be registered and undertake the corporate tax compliances. Transfer pricing. So recently the decision on transfer pricing was majorly revolving around the threshold for maintaining master file and local file. So it is mentioned as a taxable person who meets either of the two conditions which are prescribed is required to maintain both master file and local file. So the two conditions are where the taxable person for any time during the relevant period is a constituent entity of an mini group that has the consolidated group revenue of 83.15 billion or more, or where the taxable person's revenue in the relevant tax period is 80 to 100 million or more. Here it will be very crucial. The second point, if we are deciding on forming a tax group, so the tax group's threshold of 200 million will be considered over here. So this will be crucial from that perspective, deciding on forming a tax group or not. Now, it has also prescribed an inclusion list and the exclusion list, which gives us the list of transactions or arrangement with the entities which will be covered in the local file, and in case of exclusion, which the transactions with the entities which should not get covered in the local file. So broadly, in the inclusion list, it is the transactions with a non-resident person, an exempt person, or a resident person who's opted for a small business relief, or a resident person who is subject to different tax rate. That is, for example, free zone person. So any person broadly who is not getting taxed at a similar rate of 9%, then that is getting covered under inclusion list. And in case of exclusion, the resident persons other than those specified in the inclusion list, a natural person acting independently of each other, a juridical person, which is considered to be a related party or connected person by virtue of being a partner in an unincorporated partnership, acting independently of each other, or a PE of a non-UAE entity who is subject to tax of 9%. Here, it will be crucial to understand what is independent. How will one determine what is independent? Independence. So independence test is also prescribed. So it majorly covers that transactions or arrangement must be taken in the ordinary course of business. And if the parties to the transactions or arrangements are not exclusively or almost exclusively transacting with each other, or the activities of one of the parties may not be subject to detailed instruction or control of the other party. So in all such scenarios, it can be said that the independence test is met. However, FTA will take into account all the relevant facts and circumstances to determine whether the person can be regarded as an independent party to each other. So here the documentation, the backup working will be very crucial in this case. Further documents to be submitted must be submitted to the FTA within 30 days as a timeline prescribed, following a request or by the such date as directed by the FTA. Here broadly, we have covered the transfer pricing documentation. So TP disclosure form, basically, we understand that may broadly include the ownership information and the information on the intercompany transactions and the transfer pricing methods applied. It shall be a yearly submission along with the return. However, the format or threshold has not been announced for the TP disclosure form yet. Master file and local file generally includes, master file will have a broader information picture, and local file will be typically regarding the transactions between the detailed description of the transactions between the related parties. And there's a country by country reporting also, which includes revenue and profit, current tax standing, capital retained earnings, number of employees, and the complete list of entities and PEs. The format of disclosure form, master file, and the local file is yet to be prescribed. Now, the next topic is small business relief. So basically, the small business relief is available to taxable person. Sorry, a taxable person may elect to be treated as having derived as any taxable, not having derived any taxable income for a tax period. So who can claim that? Basically, who is neither a qualifying free zone person or a member of a MNE who is in scope for CBC reporting requirements. And the person who qualifies and elects for the relief remains a taxable person, even if it doesn't have to pay any tax, but he will remain a taxable person and required to meet the compliance regulations such as registration, return filings, etc. The threshold for the revenue is 83 million. So any taxable person any resident taxable person who's earning revenue of 83 million or less is, for the relevant tax period as well as for the prior tax periods, there's an election to be made. The relief will apply only in the tax periods ending on or before 31st December 2026, unless prescribed otherwise by the government in future. So basically, the taxable person has a window of 3 tax periods for making such an election. Revenues will be calculated based on the applicable accounting standards in the UAE. There will be a limitation to carry forward of losses or disallowed net interest expenditure incurred during the period where the relief is claimed. And yes, where the most important one again here, the GAR will apply if the FTA determines the taxpayer has artificially separated the business of activities to qualify and elect for this relief. Tax grouping. So a group can be formed under corporate tax purposes also, and the conditions for that is that at least 95%, there should be a parent-subsidiary relationship, and the parent should at least hold 95% of shares, voting rights, and profits and net assets of the subsidiaries. All group companies should have the same financial year and must use the same accounting standards. And the persons who cannot form a part of tax group is qualifying free zone person and an exempt person. Further important points are that tax group is treated as a single taxable person. The parent company will be responsible for settling all these corporate tax dues, for all the compliances, for all the filings of tax returns, as well as the maintaining relevant financial statements and the records and transfer pricing documentation as well. And yes, VAT and CT groups can be different. Okay, an interesting topic over here. Now, general interest reduction rules. So what has come as per the decision is there is a de minimis net interest expenditure which is specified now. So as per that, any interest expenditure which is less than 12 million, there in that case the analysis of 30% EBITDA or the thin cap rule is not required. The general interest reduction rule in fact doesn't apply, and complete interest expenditure can be claimed. In case where the net interest expenditure exceeds 12 million, it has to be seen that the cap of the available deduction will be either 12 million or 30% of EBITDA. So we have explained this in way of an example. So in example one, the net interest expenditure is 11 million, which is less than 12 million. So analysis is not required and complete 11 million will be allowed. In example two, the net interest expenditure is 13 million. EBITDA is 50 million. So 30% of EBITDA comes to 15 million. So here the cap will be either 15 million or 12 million, whichever is higher. So we can get complete 13 million as the interest expenditure. So the complete 13 million will be allowed. In the third scenario, the net interest expenditure is 13 million, the EBITDA is 30 million, and that means 30% is 9 million. And so here the cap will be either 12 million or 9 million, whichever is higher. So here the deduction allowed will be only to the extent of 12 million. So out of 13 million, only 12 million can be claimed and 1 million will not be allowed. Further going under this section, it will be the interest which are covered under this reduction rule is interest of payments economically equivalent to interest shall be considered regardless of the IFRS classification. This is a crucial point over here. Further, amounts incurred in connection with raising finance shall also be considered. Guarantee fees, arrangement fees, and commitment fees, and any other similar fees shall also be considered. Interest component of forward contracts, future contracts, options, interest rates, foreign exchange swap agreements, and other financial derivatives, and used to hedge risks directly connected with the raising of finance shall also be covered. And interest on the lease accounting as well as capitalized interest also will be considered. Other key points here would be taxable income post the prescribed adjustments to be considered for EBITDA. So this is a very important one. So the taxable income has to be computed first as per the provisions of the law, and then EBITDA has to be applied to that. And in case where the EBITDA is negative, EBITDA to be considered as 0. And the disallowed net interest expenditure may be carried forward and deducted in the subsequent 10 tax periods in the order in which the amount was incurred. So ideally, FIFO method has to be applied for the claiming brought forward interest reduction. The rule shall not apply to certain entities such as banks, insurance provider, a natural person undertaking business, etc., or any other person which may be determined by the minister later on. Natural person. So natural person who conducts a business activity or conducts a business activity in UAE shall be subject to tax in UAE on the income derived from the UAE or from outside the UAE insofar it relates to the business or business activity conducted by him. So basically here the threshold is prescribed. So if where the total turnover derived from such a business or business activities exceeds 1 million within the Gregorian calendar year, only then this will trigger. And there are certain exclusions also to the turnover. So this is quite crucial. So the wage, the salary of the natural person, the personal investment income, the real estate investment income, which does not require a license, these all will not be considered for the total turnover calculation. The compliance requirements. So natural person who is not conducting business activity shall not be required to register. The person who is conducting and exceeding the threshold will be required to. Okay, now we have just listed down few clarifications provided by explanatory guide, which would be important ones. So the first one is the foreign entity recognized as a UAE resident by virtue of being managed and controlled in UAE will not be qualified as a free zone person, will not be qualified as a qualifying free zone person in UAE. Expenditure for staff expenditure is fully deductible. Compensation paid to direct or indirect owners that is not fixed and determinable, but instead contingent upon the financial performance of the taxable person shall not be deductible. A single taxable person may transfer the tax losses to more than one taxable person. All the members of the tax group will remain individually responsible for the provisions regarding withholding tax whenever applicable. A qualifying free zone will not be able to benefit from the 0% CT threshold of for income up to AED 375,000. So the complete income of qualifying free zone will be subject tax 9%, and 0% benefit will not be available for income up to 375,000. UAE branch of a resident person will be treated as the same taxable person, and the resident person should include the income and expenditure of all of its domestic branches in its tax return. However, UAE branch of a foreign entity shall be regarded as an extension of the foreign entity. Okay, what we have done here is we've just listed down a few provisions, the provisions where the thresholds are prescribed in the law. So we have just for this is for ease of reference. So these are the provisions. These are the articles where this is where the thresholds are prescribed. So all the applicability of all these articles will be subject to complying the thresholds. So this can be used as a ready reference. And we've also provided a list where the holding percentages are prescribed. So in the law, there are various articles where different percentage holding percentages are prescribed for getting the benefit of the relevant articles. So we have captured those as well. And the last one is we have listed down the clarifications, key clarifications where the cabinet decision, ministerial decision is still awaited. The key one is the list of free zones. Then we have covered everything article wise. So this can also be referred as and when required here. So I think that's it. We can go ahead for the Q&A.
Thanks, Radhika, for the detailed presentation. Some of the aspects we could not address specifically or discuss in detail because of paucity time, but we have just captured in the slide deck, which will be circulated later. For that, you can refer those slides for your reference, and in case of any clarifications, feel free to reach out to us. We've got a lot of questions, and we thank all the participants for their keen interest in that. So we'll start with the question answers. For first question is, what is the sufficient number of employees required? And in terms of employees, also operating expenditure or assets, also whatever is mentioned in the to maintain the adequate substance for a qualifying free zone person. So as such, the ministerial decision or the cabinet decision, they do not prescribe any list or any number of employees or any amount per se for defining adequate substance, and it has to be seen on a case-to-case basis. But the principle, so first, Reliance you can make out from the ESR reporting guidelines also. So there also they have discussed in detail about the substance requirement. So the companies which are already maintaining their substance requirement as per the ESR, so they can take guidance from there also. And apart from that, as a general principle, you have to see that the kind of activity, core income and generating activity that you are performing from the free zone, whether the number of employees are sufficient to do kind of activities, whether the operating expenditure incurred is sufficient for doing that kind of activities only. So the main guiding principle remains that commercially it is justifiable or not. The substance, the employees or the expenditure is and the core income generating activity is commensurate to each other commercially or not. So that is the most important thing. Third party shipment for a free zone companies can be qualified as as we mentioned that as from the language in the paragraph 3 of this ministerial decision number 139, it seems that they will consider only the distribution in respect of imports which are done into the designated zone. So anything which is not imported into the designated zone may not qualify. So the third party shipment or drop shipment may not qualify as of now. Same question again, export from UAE on bill to ship to basis where goods are not coming to free zone will be a qualifying income. Prima facie, the answer is no as of now. Then the question is about Article 1 of MD 139 provides list of 12 activities as qualifying activities. Article 2 provides the meaning has to be considered under the law regulating these activities. Does this mean the activities which are qualifying and covered under ESR meaning shall be considered from here? ESR. So as I mentioned that yes, the definition and reference can be made from the ESR guidelines. However, it may be possible. So you have to see two, three aspects. First, the ESR guidelines. Second, your trade license, and overall on a business parlance, the kind of activity that you're doing, whether that will fall within the scope of that activity or not. Unless the government comes up with a specific definition for a particular activity, like manufacturing, like logistics, or like any other activity. So the government may come up with the specific definition. In absence of any specific definition, a reference can be made to the other laws and the trade license. WST paid tax paid to Oman and KSA entities. Can this be claimed as a tax credit? Yes. So that is one of the important points. And Article 47, specifically Article 47 of the Federal Decree Law, specifically deals with the foreign tax credit, and it says that corporate tax due under this decree law can be reduced by the amount of foreign tax credit for the relevant period. And even in the explanatory guide, they have specifically mentioned about withholding tax also. Is the 5 million also revenue or profit? I think you're talking about this 5 million threshold for the qualifying free zone person, de minimis requirement. So this is revenue, not profit. Whether interest earned on surplus funds exceeding 5 million is covered under the excluded activity or a non-qualifying activity. Actually, this is a this surplus fund is something which it is not defined actually. So we have to see whether that surplus fund is ancillary and it is as per the business requirement or not. So though the guidance is not available here in the UAE law as of now because the law is still developing, but if we take reference from the other laws, other countries, so their general principle is that if there is a surplus fund which is not required in the business and you are just keeping it as a fixed deposit and earning interest therefrom, it may not fall within the list. It may not be considered to be ancillary to the main business activity. But however, if you have given this deposit as a condition to the main activity, suppose if you have earned a contract and as a condition to that contract you have to make some deposit into a bank account or with your customer or any specific escrow account, and you are earning interest on that, then possibly you can say that this deposit is ancillary to the main activity, and therefore it will be covered within the scope of qualifying activity. So this again has to be seen on a case to case basis. What is the requirement of your surplus fund requirement plus utilization of your surplus funds? Then this next question is high C sale by free zone entity or LLC company. What will the mention? As I mentioned, high C sale by a free zone entity may not be covered within the scope of qualifying activity. Adequate number of employees and adequate number of expenditure. Adequate word is not yet defined. We have to go by the commercial requirement. Whether again the question is whether logistics covers the sub chartering of vessels chartering. So as we see that shipping operation is specifically covered otherwise in a different line item, and then logistics is also covered in a different line item. So we have to see the overall activity that you are doing and whether it will qualify within the scope of logistics. We'll have to see the trade license, etc. also to comment on whether this will fall within the scope of this logistics services and whether it will fall within scope of qualifying activity or not. Business center office of a free zone company will be disallowed. As I mentioned, business center office where there are no employees and no physical activities actually happening, so it may not pass the substance test. So it is important to have sufficient number of assets, employees, operating expenditure to claim the benefit. Is consultancy fee income by a free zone company from outside UAE considered as a qualifying income? Unfortunately, no. As we mentioned that services, they have given a very restricted 6 or 7 line items. So consultancy fee essentially may not cover within the scope of qualifying activities unless it is in the nature of headquarter services to the related parties. So for that headquarter services, again, we can take a reference from the ESR guidelines because there is no definition under the law, and which is essentially provision of services of the senior management personnel and all. So there, as a for as part of the headquarter or overseeing the group operations, if it falls within that location from the and that too from related parties, it may fall within the definition of qualifying income. Otherwise, if it is a non-related parties, then consultancy fees may not be covered within the scope of 0% taxation. What exactly is meant by qualifying activity and excluded activity? They've already defined in the ministerial decision number 139 a list of qualifying activity and excluded activity that we discussed in our presentation. Then there is a company-owned residential property allotted to employees for a nominal amount, which that is 5% of salary. So essentially, the question is whether recovery of rent from employees may also be covered within the definition of exploitation of immovable property. If yes, what if recovery is discontinued? So yes, I mean, in that case, possibly it will be covered within the definition of exploitation of immovable property, because whatever rent you are receiving, whether it is a normal rent or a discounted or nominal rent, the nature will not change. The nature will be in the nature of a rent only. So it may may qualify within the definition of excluded activity, unless you prove that it is ancillary to your main business. So that is again has to be examined on a case-to-case basis. Money exchange business activities are also excluded. Yeah, so money exchange is not specifically included, and it is if it is a part of the banking activity, then possibly we'll have to see. Actually, honestly, money exchange business I have not yet thought about it, so we'll have to see. Can you please explain again in point K in qualifying activities regarding distribution in or from the designated zone? So what we understand, distribution in or from from designated zone. In designated zone is essentially what we believe is it should be a trading or distribution within the free zone from one free zone person to another free zone person in the designated zone. Whereas from the designated zone, it should be physical sale from the designated zone, either to overseas customer or to a mainland customer. So that's what we understand from the definition of in or free from the designated zone. Any Jabza company have asset which is given for lease in mainland? Are they qualified for benefit of CT? Uh, I believe you're talking about an offshore company, possibly, or otherwise also. Jabza company have asset which is given for lease in mainland. So asset, do you mean immovable property? If it is immovable property, then it is of course excluded. If it is any other kind of asset, we'll have to see in any other kind of asset also, except the aircraft leasing. Other leasing is not specifically included. So this is also not covered. In case of general trading company in free zone, the 50-year tax exemption was committed by the government. How can this be taxed as impossibility of performance? So this, essentially these are this is a question on how the government can tax it. I mean, essentially we have to see it on the law as it stands today. Tomorrow, if the government provides an exemption for the high seas sale, specifically some clarification comes, then of course, that will be considered. As of now, it doesn't seem to be covered. If a 100% owned foreign subsidiary is subject to less than 9% corporate tax in local, then will the dividend distributed by a foreign subsidiary be taxable in hands of UAE holding company? Answer is yes. What happens if we don't have legal ownership of shares but a gentleman agreement? See, any agreement which is not legally acceptable, or which cannot be established in the court of law, possibly that is not covered. So we have to see the legal ownership and the beneficial ownership also, but that beneficial ownership should also be through an agreement which is admissible in the court of law. So that we'll have to see on the overall documentation basis. Usually one question is, usually expenses are incurred common for exempted and taxable income. How the apportionment shall be made to disallow expenses related to exempt income. The exempt income, like a dividend, normally has no or minimal expenses. How to avoid discretion in India, Section 14A Rule 8D has been debated and litigated. So it's a good question actually. So as you mentioned about India also, that they have specifically prescribed a rule 8D for disallowance of expense in relation to exempt income. Possibly the government may have to may come up with a rule here also. In absence of any rule, it will be based on the self-assessment of the company, that whatever expense, if there is any directly identified expenditure, like that you've incurred in that in relation to that income, is there any dedicated employee to manage those investments, then possibly you can exclude that or disallow that. Otherwise, you'll have to use the businessman's judgment to disallow that. If withholding tax is deducted in foreign jurisdiction while distributing dividend, will be allowed to claim WST? Answer is no, because the Article 47 specifically talks about foreign credit under this decree law cannot exceed the amount of corporate tax due on the relevant income. Because the relevant income here is not taxable, then the corresponding foreign tax credit will also not be allowed. Then there is another question. Free zone company as a mechanical construction company, the revenue, how will consider to mainland and within the free zone? We'll have to, examine your case in more detail, what kind of revenues there from or within or outside company, and then only we'll be able to advise on what will be the tax rate. For claiming participation exemption, what if the foreign company is in free zone enjoying tax exemption? However, once the exemption period is over, it is liable to tax. Is payment of tax in actual required for claiming the participation exemption? So yes, it is. It is basically, the word used is subject to tax. So subject to tax and liable to tax are two different terms which are often litigated in the taxation regime. So it should be subject to tax, means there should be actual tax liability. So that's what. Then there is a question: what is the treatment for income of a fully owned subsidiary of a UAE company incorporated in other countries? So because subsidiary is a separate legal entity, so that is not taxed in the UAE unless that subsidiary is deemed to have its place of effective management and is considered to be a resident of the UAE. So unless the place of effective management is triggered, the subsidiary will not be taxable here in the UAE. The dividend received and capital gain from investment is taxable in hands of an individual. In hands of an individual, it is not, because it is the income in the nature of personal investment. The dividend or capital gain received from investment is not taxable in UAE. Then there is a question: holding company in Qatar, subsidiary in the UAE. Day-to-day operations are managed by UAE, but capex decisions taken by Qatar office. The two shareholders, one in India. This will require detailed examination. So I can't say. We will have to consider the overall facts and circumstances. Then we have a question: how for 5% participation exemption, what if 5 UAE mainland and 1/5 holding 1% each in foreign company, will it qualify? So if it fall within the definition of a qualifying group, which is minimum 75% common shareholding, it may qualify within the 5% participation exemption. So that we'll have to see. But if you are a qualifying free zone company, then we'll have to see whether you will fall within the qualifying group or not. So for 5 UAE mainland company, the answer is clear. We'll have to examine about the free zone company, whether it has to be included or not. How the revenue is defined? Is it as per invoicing? Revenue is as per your applicable accounting standard. Based on whatever revenue recognition criteria you follow as per your financial statements, and that will be considered for the revenue. Uh, then there is a question for Radhika. Can you please clarify, in case of a tax group, interest ceiling of 30% is to be considered for each group company or aggregate basis? For the tax group, if aggregate basis is allowed, how each company shall apportion to the higher interest claim basis 30% of tax group EBITDA. So I'll answer on behalf of Radhika only. See, if you form a tax group, then you are one taxable person. Then the ceilings and all have to be seen on a overall group basis only. So we'll have to aggregate all the transactions. We'll have to calculate the EBITDA, taxable EBITDA of the tax group itself, and then we have to see the test this limit. If the transfer pricing rule is followed by free zone companies to supply to related party in the mainland, that particular revenue is taxable at 9% or not. So, this 9% eligibility of 0% or 9% is depends on the qualifying activity. Transfer pricing rule has to be followed by any qualifying free zone person if it wants to claim the 0% tax benefit. So these two conditions are mutually exclusive to each other, and both the conditions have to be satisfied. So I think we are done with the questions, I think. We are a branch of a foreign. One question is, we are a branch of a foreign company tried to register for corporate tax. It was rejected, stating that registration is not yet available. That's what we mentioned in our presentation also, that corporate tax registration is presently open only for the private companies and public joint companies. So for other kind of taxpayers like qualifying free zone person or even the branches of foreign company, it's not yet open. When it will open, nobody has an idea about it. So the government will have to wait for the government update on that. How is a Jabza offshore company treated if the company is only having investment in property in the UAE and securities in and outside UAE? So first of all, Jabza offshore company will be considered as any other UAE company, and if it has to claim the free zone benefit, it will have to meet the substance requirement and other conditions as it is applicable for a qualifying free zone entity. So we are still awaiting the clarification from the government, or is there any specific treatment is to be given to the Jabza offshore company or not? And then only a final view can be taken in respect of taxability of their income. I think we are done with the questions. So we'll share a copy of this presentation. In case you have any other questions, please feel free to write to us, and we'll be happy to answer. Yeah. Thank you so much, everyone, and have a nice day. Yeah.